So I don't think I need to introduce everybody in detail, but I just want to highlight that it's wonderful that Helena Fiestas can join us virtually. We're all of us are very busy in sustainability, but I think Helena carries two full-time jobs. Actually, she's chairing the EU Platform on Sustainable Finance, which is almost becoming an institution, and she's also a full-time Spanish regulator. So Helena, many thanks again for making yourself available and bringing your perspective. We've heard from Ulf Erlandsson with his really interesting and metric-heavy presentation earlier in his keynote. Do I need to introduce Sean Kidney? I think many of them know he's the CEO of Climate Initiative and a real titan of the sustainable finance world. Now, the idea behind this panel today is to perhaps delve into some of the more prospective questions and try to think ahead and cover some of the strategic issues that we face in sustainable finance. And although I don't like talking too much about regulation, I think we do need to start there because we have come out of 10 years of various sustainability initiatives, or sustainable regulation initiatives, particularly in Europe. And my first question would be, after all this activity and perhaps hyperactivity in Europe, where are we now, and has it been a success? And Helena, I'm going to be very unkind. I'm going to ask you to comment first on that.
Thank you, Nicholas, and good afternoon to everyone. I think if you allow me, Nick, saying 10 years of regulation, slight exaggeration in the sense of the first proposals at EU level came in March 2018, but the actual application of the first regulatory package started in just roughly a couple of years ago. What we do is start having results or can start analyzing is what has happened in terms of the taxonomy, SFDR, and benchmarks. In fact, the platform, you might know, we thought it was a very good moment a few months ago to start making a first assessment. So the extent to which the taxonomy and the wider sustainable finance framework was actually being implemented and how that implementation was going on. And the results were actually very encouraging. I would say that the key takeaways was that the taxonomy is working on the ground. Now we need to take into account that we only have 2 years of experience on taxonomy reporting, and that taxonomy reporting covers 1,700 companies, roughly the largest publicly listed companies in Europe, and that we're only covering the climate taxonomy. But when we look at the figures, what the figures tell us is that the revenues and capex alignment is higher than expected, that the capex alignment is higher than expected. We have an average of 20%. That's really good news. When you start delving into the different sectors, you realize that utilities are first in class with almost 69% of capex alignment, and then you have other high impact sectors like automobiles, real estate, and so forth. Now, in terms of investments, the first year, so that is 2022, so it's the results of the investments made in 2022 that were reported in 2023. We have 191 billion. This year, we have the figures that we have been collecting until beginning of May, and already we have 249 billion. So that is 440 billion so far invested in either taxonomy-aligned activities or in transforming the business models of these companies to be aligned with the taxonomy. Really encouraging. Equally encouraging is the fact that those companies that cannot align their capex, what they do is they set targets to it. We have 600 of those 1,700 companies doing so. And equally really interesting is how they're linking it to the transition plan, something we have been advocating for a long time. And CapEx becomes, CapEx alignment and targets within CapEx becomes an essential element of transition plans, and particularly of financial planning. Now, the last point I will make on taxonomy is that some sell-side analysts are coming out with really interesting reports where they start looking at the correlation between taxonomy alignment and performance in the market. And what we've seen is that those companies that have higher taxonomy alignment, have outperformed over the last 5 years in the market. So really positively. Equally positively is the fact that we have collected 180 billion so far, invested in funds that replicate the European climate transition benchmarks, and that 56% of the market, of assets under management in Europe are either respond to Article 9 or Article 8 of SFDR. Does this mean that everything is perfect, and really working nicely? No, not at all. We're very conscious of the challenges. In the taxonomy, we're very much aware that the do no significant harm is probably the number one struggle, and this is why we're taking it really seriously. We need to adapt the compliance of do no significant harm to the different users and users, and that's exactly what we're doing. With the Commission, we have committed to really make compliance much, much more usable and apply, be able to differentiate when you apply it to revenues, to CapEx, to a green bond, versus you are the company conducting the activity and so forth. And we have in our report a whole list of usability issues that we are addressing when it comes to the taxonomy. Very quickly, I would also mention that on SFDR, it's probably and it's not a coincidence that the Commission has decided to reassess and to revisit SFDR, because probably, it's been one of the regulations that needs a little bit more readjustment, I would say. On one hand, it was not meant to be a category or a labeling scheme, and the market is taking Article 6, 8, and 9 as categories when actually they just tell you what you need to disclose on. Secondly, for Article 8 products, there's still you could report only on a portion of the fund, so that leaves ample room for greenwashing. It's quite, let's say, it's not sufficiently tangible and needs to be tightened up. And the third point, I would say that despite the fact, and that is really encouraging, that around 10% of Article 8 products set up greenhouse gas emissions reduction targets and disclose their carbon footprint, we could, say that very few funds, generally speaking, in Europe are really investing in sustainable investments. There's too much on ODS where there's no concrete, or tangible sense of what is really investing in and what's the investment strategy. So we are working as we speak on a categorization of products that tries to find the right equilibrium between the needs for the retail, the flexibility to really continue encouraging innovation in the market, and last but not least, the mobilization of capital flows towards sustainable investments.
Thank you very much, Helena. Now, Sean, I'm going to turn to you. So we're hearing a positive assessment from Helena, and I don't want to paraphrase her, but also I think Helena is saying that we're less focusing on the do no significant harm because we know that that has been problematic for taxonomy alignment. But what is your view? I mean, you've been very involved both in Europe but also in Asia with regulatory developments. Do you think that, on balance, it's a success? Are we on the right track, or was it more negative than positive?
This market, of this sustainable finance movement, started from the buy side. It was investor-driven. It wasn't driven by regulation. Came later, and that, due credit to investors and development banks who flushed out this investor demand. I'm looking at you as well, and the various others and other development banks, to create this idea that matching the anxiety investors felt around climate action could be addressed through an instrument. And of course, when we started, when you and I first met, it was a market of some digit billions, and now we are in the trillions. So that's success. Let's just save that for a moment. Now, regulators came in some markets in a way that made a total difference. You know, when I was a member of the People's Bank of China Task Force in 2014, I was told by the bank, said to me, look, we can't allow banks in the province to start issue green because there'll be scams everywhere. We have to have regulations. So they actually said they would not allow banks to issue green bonds. That was a directive that came out from the People's Bank of China until there were regulations in place, and it worked. It worked. Whilst we've had arguments with the definition in China, what qualifies green, all pretty well fixed up now, by the way, in the early days, the truth is they never had a bond issue that wasn't in line with the regulations, and it worked. And now China is the world's largest green bond market as an individual country, so on. And that was replicated around a bunch of emerging markets. So regulation clearly worked. In Europe, the impact of the sustainable finance regulation, the disclosure requirements have been astoundingly successful. Of course, as Helena is saying, Helena and I work closely on these matters, there are lots of buts. There are but all over the place. I mean, what do you expect? It's a massive world-changing regulation. Of course there are going to be buts all over the place. We've got work to do. Nick knows what I mean about that. And this is something we hope, Helena and I hope, will make a lot of progress in Europe this year. But if you start looking at the extent of which regulation around the world has turbocharged the market and has turbocharged action, it's extraordinary. Last year, I was in Bratislava at a central bank of Slovakia event, and I had banks coming up to me, local banks, talking about how they had teams looking at taxonomy and how fantastic it had been for these teams to get a conversation going within the banks about sustainable finance. I mean, that is a real change. Forget the reporting. The fact that all these banks had teams and they were generating product as well as disclosure was really the story. And that's absolutely what's going on. I mean, there's other aspects of regulation too. I mean, central banks, soft touch, if you like, which is most of the power of a central bank is the conversations, the corridors. It's a form of regulation, has been incredibly powerful. In fact, the NGFS work, and I've had a bit of involved right from day one, has been amazingly powerful to change the economic normality of addressing climate change. You know, in a way that Europe has power of normalisation. So the central banks have normalised the idea that financial institutions need to address climate, and that has had enormous power. And of course, in emerging markets, there's regulations in Brazil, in India, in China, in Malaysia, etc., etc. So if I start looking around the world, I'm thinking, you can't actually, there's no way you can actually say it hasn't had an extraordinary power. What we're on about now, and the discussion we do have to have, is how to improve it. Of course we have to improve it. In Europe, we've got problems. Hey, the green bond market is a bit of a mess at the moment in relation to the taxonomy because of some requirements of the EU GBS. So we've got to fix that up. But on the disclosure side, where a best efforts approach to do no significant harm has happened, it's just working reasonably well. It could be a lot better. We've got to improve. And this is one of the things that I think in this particular juncture, this new commission that's coming in, there is appetite to do this, a strong appetite. There is appetite amongst industry. I've been running the line. It's time to make it easy. Time to make it easy. Look for everywhere we can make it easy for investors, easy for corporates, easy for banks to act with the necessary ambition. We can't sacrifice our climate goals. I mean, we won't give our future to our children if we do it, but we can absolutely improve the nature of regulation, the nature of guidance, and so on. And I think that's what Helena's alluding to here. But it's not just here. I can see it in other countries too. You know, in Japan, where you heard about the GX plan on the previous one, this is a fantastic innovation. It's not regulation in the sense of financial sector regulation, but it is government guidance about what transition is. There are some things I'd agree about. 5% of it I argue with Kobayashi-san all the time about. But the bulk of it is just superb, and it's an activist plan linked, and this is the next thing we're going to see happening everywhere, linked to incentives, support mechanism, money from government to allow steel companies to invest in low-carbon steel rather than complain about how they can't do it because they can't get the pricing right, because the market won't buy, etc. That close relationship between government enabling measures and support, DBs, and what transitionalists look like is now what you're going to see. Now, you're seeing it in Europe, you're seeing it in China, where the Hebei province produces 12% of the world's steel, has announced a steel industry transition plan, which is fantastic. It's hydrogen. It's about electric arc furnaces and so on. And this is where we're going on the back of all this successive regulation.
I'm going to jump in and transition because you're going to cover the whole panel if I'm not careful. It's wonderful to do a panel, since you never have to worry about you're not going to do the time. You're going to do the time. You just have to make sure you cover the topics. I'm going to move to Ulf, and we get along very well, by the way, so it's absolutely fine. Sometimes, but coming to Ulf and switching this forward. We just talked about regulation, but what should be our priorities looking ahead? Is it fixing regulation? Is it other policy initiatives? What do you think, Ulf?
So there was a very interesting story on Bloomberg or other news media as well last week, where it was blasted out that the UK FCA had started their first ever climate investigation. And that's the UK FCA, the regulator of one of the biggest capital markets in the world, starting to look at this for the first time. And this brings me to the first point I want to make. It's great sometimes to have regulation. That will be my second point. But the first point here is that there needs to be sanctioning. There needs to be capacity to actually, judge whether something is right or wrong. There needs to be a place where concerned investors can go and say, we want to raise this issue with this company or this issuer, greenwashing, et cetera, et cetera. And we want to see some sort of effect of that. And counting on your one hand's fingers, how many sort of big sanction measures have you seen? For example, Ayla mentioned it versus green bond, greenwashing, or anything in that regards. There's very little capacity, and there was another story on that to actually go in and research these things. And one of the issues here, and that's particular, I think, and I throw the question out there, is that when it comes to something like the EU green bond regulation, that will be eventually evaluated by the national competent authorities. So that will be, Finansinspektionen in Sverige. There will be various different jurisdictions in this one. And the implementation is incredibly important when it comes to regulation. How do you actually make it work? Is it going to be a swift process? Can you have precedents and so on? So you have to remove a lot of that uncertainty in terms of what is actually the regulatory system going to end up looking like. Secondly, I do think there is a certain streak of regulatory overreach. I was one of those enthusiastic buy-side investors 10, 11 years ago when this green bond market really kicked off, and I loved doing deals with a lot of the people here in the audience, and we would discuss what was going on in there, and there was a market solution to something. And believe it or not, but a lot of people on the buy side are actually sort of infatuated with markets. They like markets. They like the sort of the civil contract that's in a bond contract between you as an investor and the issuer as an issuer. Now, over-regulating that takes some, mind me saying it, some of the fun out of the equation, and also makes it much more inflexible in one ways. Going back to the keynote speech I had here, I very much focus on sort of the outcomes and the probabilities of these outcomes actually materializing. And the problem you have if you start over-regulating some of the things is that you will have investors coming and saying, okay, this investment checks all the marks for the regulator's requirement in order to put it in whatever I call the fund, which the regulator has approved. I've done my job. I don't have to think that much about the probability of the outcome actually materializing. And I do think that sort of loses one of the engagement streaks. And we, to some extent, have seen it when we've been engaging with investors on SLBs. SLBs have had no natural home in, the former SFDR classifications. And I think that's actually improving now, but it is an issue.
Well, hang on. Are you saying that the only way forward is we have to have active engagement on the part of all investors, when the bulk of money is in passive, as it is now anyway, and most investors don't have the due diligence capability to be able to assess a bond on a green credentials come what may? I mean, isn't the whole point of this market to have a few active leaders who can really move things forward, and then everyone else needs to be sheep, following the rule sets or the guidance or whatever. Isn't that what we've got to do?
Well, look at something similar here in terms of financial analysis of companies, which is very similar to what we're doing in terms of transition and sustainability analysis. Would we accept that the regulator tells us what is a financially sound company? Or would we actually allow that to be the case of the investors, whether they be in passive or in privates? And as it is right now, we have lots of rating agencies, for example, private outfits that helps us determine roughly what sort of the risks, the financial risks are, lending to a particular company. And that has been a pretty good and strong sort of solution with these fallacies, but governments don't always, or regulations don't always help in that sense. I just want us to be sort of humble in front of that fact. It's very good that we sort of hard define the very intricacies of taxonomies and so on. But if I see an issue of greenwashing in the open day and try to raise an issue of it, we're sort of sometimes an activist outfit. It's very hard to reach anyone. What's the phone number you call when you want to say that this is some sort of form or shape of greenwashing going on there? It's very hard.
Just coming back on your first comment, do you think that we need more regulatory sanction than in the market? I mean, do you think there are behaviors which have emerged which require that intervention?
Yeah, definitely. I mean, we pushed a case, I think the other year, where there was a massive oil and gas company transaction. Use of proceeds was actually going to be to fulfill an oil sands purchase. And lots of funds with oil sands exclusions bought those bonds because the company had not been ranked up as an oil sands. They would only potentially be that after the transaction. And there is no regulatory sanction. You try to raise the issue, and there is just crickets when you lift that receiver. And yeah, that is frustrating. I think there needs to be, and the NCAs are saying that themselves. They need more resources in order to be able to cope with this.
Yeah, that's really interesting, substantive point. I want to come back to Helena. Helena, we just stating the obvious. Looking forward over the next Commission and Parliament, we're going to be in a different environment where there may be less proclivity to support sustainable and green initiatives. I mean, in that kind of tougher or potentially tougher environment, what would be your priorities?
Thank you, Nick. And let me very quickly say, we have not been seeing many sanctions yet within the EU market, but what we have seen is loads of requirements and questions from national competent authorities to both issuers and financial market participants on their reporting, and a lot of requirements to readjust the reporting so they're accurate with the regulatory requirements. On that note, Nick, I think that the good news is that the building blocks have been done. Yeah. So the what I call the big jigsaw of the sustainable finance framework, all the pieces have been done now with the corporate sustainability due diligence directive. And talking about sanctions, there you go. It's the one regulatory regulation that actually doesn't look at transparency, doesn't have transparency requirement, but conduct, behavioral requirements. Anyway, the big pieces of the jigsaw have been done. Now we're moving fully to an implementation phase. So in that implementation phase, I'm going to be very short because we've talked about it already. We need simplification. That's the time to look at usability, simplification, the tools to support, look at the special cases, SMEs, developing countries, and consistency. Yeah, I think that we need to recall two very important things. The first one is the character, the novel character of the framework, and how bold the Commission was when it launched the Sustainable Finance Framework, and the very fact that each piece of the jigsaw was, although they were part of a big vision, they were negotiated and developed separately. So now when you try to put them together, they don't quite fit, so you need to sort of polish them. Yeah. So that's one hand. On the other hand, I do think that there are challenges, that we are going to face challenges to move to the next level, because the next level, in my view, requires a unity of vision and requires a lot of boldness. In my modest opinion, we need three things moving forward. The first one is targeted supporting policy measures, including incentives. The second one is the final development of sectorial strategies, and those sectorial strategies will have or should come as a result of a strong and close partnership or dialogue between the private and the public sector. I'll come back to that point in a minute. And then what we also need is to have a vision moving forward in terms of the different sectors, and a vision in terms of full-on consistency, not only now within the sustainable finance framework, but for all the different sectors. We need to have consistency from a sectoral pathways to the sectorial policies, to what the taxonomy says, what the benchmarks embedded in carbon markets, and so forth. And if we take one step back, and in order to explain what I just said, we have now four key, tools, if you wish, in development. On one hand, we are starting to monitor capital flows. The platform just published a report on the methodology to monitor capital flows using the sustainable finance framework. In very shortly, we will be able to see how much money actually is invested in each economic activity and through which financial instrument. So when that's on one hand. On the other hand, the Commission is working on sectoral pathways and sectoral and technological pathways. So we will have that very important element, both of this, the monitoring of capital flows, knowing what activities are underinvested, and at the same time, the sectoral pathways should feed in a much, much more accurate investment or assessment of the investment gap at the level of economic activity. With that, we should start looking at the overall strategy that we need to put in place in Europe for a sector. We have the taxonomy give us, what is happening at the level of an activity, the entire value chain, but now we need to look at the whole strategy. What are the technologies that are underinvested and that we need? Where is that we have a competitive edge? What are the critical material, raw materials that we need to feed, that we don't get, all that type of that discussion where it is about, what is our strategy as Europeans for the different sector is the discussion that we need to have. And I believe that very soon we'll have the elements. Now we will need the political backing to have them to sit down, public and private sector, and to start, thinking where in a context of competing public funding, what the money should go and what type of incentives for which activities, technologies, and so forth.
Helena, thank you very much. And an interesting shift in perspective. And let's see if indeed we can focus on those new priorities. I want to shift the conversation a bit now and come back closer to the market. And perhaps starting with Ulf, but very interested in your view on this, Sean. But Ulf, in your keynote speech, you were speaking about the sustainability linked concept and how it and how it can be applied and statistical probabilistic approaches, etc. And I think that very much illustrated the theme of innovation in the market. But the challenge I'd have for you is, do you think that after the use of proceeds concept, which is a very simple one, the innovation in this market's had a real role? I mean, we've launched sustainability linked. It was super promising. We had an initial flurry of interest, but we hit some criticism. Issuance is down. And I don't want to overfocus on SLBs, but just generally innovation. What is the role of innovation in this market? 10 years from now, is it still all going to be essentially about use of proceeds?
No, I really and sincerely hope it will be a combination of user proceeds and GCP-linked financing. I mean, they are very complementary of each other. So we try to stress that, although we've been focusing a lot of our work on on the SLB side, but don't go where the puck is already, as Wayne Gretzky used to say, right? Go where it's supposed to, where it's going. And you know, I know that Sean and CBI very much covers the use of proceeds in a very good way. Innovation is a constant somehow in financial markets, and I hope we can sort of further refine the concepts. But just as a background, I mean, I was a very heavy investor in the use of proceeds format when I was in a mainstream pension fund asset owner. And at some point you come up to, you know, you filled your buckets with the green bonds, and then you start looking at the rest of your portfolio, and you have to do something about the carbon intensive, the transitioning sectors. And there is, especially when you come to the sort of oil and gas industries, there's just a fundamental lack of trust in terms of the credibility of some of the decarbonization commitments. Hence, you need to hard code something else, and that's where the use of or the GCP sustainability linked format just becomes much more intellectually attractive. Now, specifically on the evolution there, I think, you know, we spoke about Enel here earlier today. There were quite a number of really impressive sort of original issues. Then the market was washed over with a lot of things that you just couldn't price, right? I mean, you have 3 SPTs on things that might be or might not be correlated, and you need to go into a higher degree of mathematics if you want to price it. So hence it didn't price. It priced flat to or nothing differently. And hence there was no incentive for the issuer to actually do it once the hype was over. If they didn't see a lower cost of capital from actually achieving sustainability targets, why even bother? And if there is a stigma attached to failing. And I think that's the sort of the SLB 2.0, and that what we're trying to point to is that if you're successful in terms of your decarbonization targets, your sustainability targets, you should be facing a lower cost of capital, a fundamental lower cost of capital. And that is because you are de-risking, but you're doing this in exchange together with the investor. And we just find that very compelling. Now you can further refine the concept and do lots of other things, but you know that's up to the innovation that we can see. I mean, I tried one idea here today. You know, that might not work out, probably will not, but there's interesting variations thereof.
Sean, what do you think?
You know, the drivers for thematic issuance and so on, not so much pricing. I disagree a bit with Pfaff about this, in the sense that every investor we poll, every issuer we poll in the world says they're doing it for investor relationships. They're doing it for their positioning. They usually get a pricing benefit. You know, I spoke with one of the treasury team of Swire the other day in Hong Kong. 60% of all their issuance is now thematic, which is pretty amazing. They're Hong Kong's largest property developer, property portfolio owner. And they are continuing to get a greenium. You know, I know every month or two there's an article on the Financial Times about the greenium disappearing. Speak to the Australians about that and their sovereign bond issuance. But that's not why they do it. They do it because the investor relationship. I'm sure it makes it a lot easier internally. So there are other issues around positioning vis-a-vis investors because of the overarching concerns of investors that I think drive this change. And of course, the benefits flow down, you know, the real benefits of issuance for me, to do with the nature of the relationship that issuers have with the rest of their organisation. I mentioned those banks in Slovakia earlier. The internal conversation that taxonomy had engendered is the real benefit, the education amongst the institution. And you can talk about that from Exim Bank in Canada. The Treasury used to say this to development banks too. So there's actually, it's complicated, the benefits. You know, I resist saying we need to have a greenium, even though we've largely got a greenium, because I don't think it's a real driver of the change. And for some sovereigns, yes, it's a reason to do it, but after they've done it, there are many other reasons they want to do it. And I've never found a DMO that wanted to do a green bond in advance, ever.
And testify to that. Yeah.
But equally, I've never found a DMO yet that hasn't become enthusiastic after issuance. And it wasn't because of the greenium. So they're the things I'd say. Just on the question of innovation, initial question, you know, I'm torn on this one, I'm sorry. My stakeholder base are institutional investors. I've never met an institutional investor that likes innovation. They want safety and security. They want certainty. They want something which is predictable. So I've got to be careful here. There is innovation in what counts as climate, absolutely. And that's about expanding our understanding. And there was a conversation earlier on about social. You know, we argue, and we'll be bringing out a climate resilience taxonomy guideline soon, that if you start looking at what we have to do to address climate, it's not just mitigation. It's not just physical adaptation. You know, we've got people dying in Saudi of the heat at the moment. There's physical adaptation stuff that we've got to do. It's social resilience and economic resilience. At least half the death toll that you get in climate impacts come from weak societies versus strong societies. Stronger societies survive better. That's a social issue that we need to address. Just transition falls into the same kind of argument. So, you know, and economic development, well, poor countries don't recover as well. Richer countries recover better. It's a fairly obvious thing, but it's not actually been teased out. So if we want to improve the credit rating under S&Ps or Moody's of an emerging market that's vulnerable to climate change, we've got to make them more resilient, which means we've got to make them wealthier. We've got to give them resources, insurance schemes, and so on and so on. And then there's ecosystem resilience as part of that. So through that, for us, we want to marry all these things together. And by the way, it's all the SDGs I'm talking about. I mean, gender is material to social resilience. It's women that tend to knit together communities. And financial resilience, you know, small businesses run by women that get microfinance loans have a default rate of about 3% across India and places like that. Small businesses run by men, well, guess, they have a default rate of about 20%. Our gender drinks the profits. It's not actually a great story. It's a great story for central banks, why they've got to be concerned about the lending to small business who are women, and got to be concerned about primary education, because the primary education of women is what leads them to set up small business, etc. You get an idea how we knit all these things together. It's happened, but now we need to stop having these different silos and understand this one story. So that's the innovation that's going through. The actual coupon innovation, the structured innovation, if it works, I think it's great. You know, I'm a big fan of SLBs. I just think half of them are crap, that's all.
I wish he'd stop saying that, and we've had the conversation. But Ulf is itching to answer, so go ahead.
Well, on the cost of capital argument that Sean makes here, I think, you know, the most ideal situation where I see these stepped instruments, for example, and where cost of capital really matters is looking, for example, for, you know, coal entities out of Southeast Asia, which today are facing, you know, punitive levels of interest rates if they were to go out and fund in the bond market. So they won't. So instead, they continue running their coal line. They have, you know, a cash flow positive operation. Now, they need money in order to invest in renewables to sort of switch out of that and sort of retire the coal early. So what if we actually lend them money and then allow them a step down once, you know, they actually go to a certain degree of renewables within their generation capacity, because then we can trust that it's actually happening and the investor feels that they get a stake in this, you know, decoalification in some sense. And if you can provide, you know, some credit enhancement through MDBs or similar in that structure, so it actually becomes risk-free, or not risk-free, but return neutral for investors, then that's a fantastic innovation. And I think that's where, you know, the cost of capital that suddenly this coal company will face in terms of if they're successful, that's going to be a great incentive for them to actually do something that they would not do otherwise. I do think cost of capital does differ. On the sovereign issuance side, I mean, if you can come a couple of basis points inside the curve because you're selling an option on your future success or failure in terms of hitting transition targets. I mean, a few basis points if you're a treasurer or, you know, at one of the big sovereign issuers, that's massive. So I do think it's actually not only the sort of the good feel of having issued in a certain format and engaged more investors. It is also basically boiling down to, you know, lowering cost of capital if you do the right thing.
Thank you very much. It was a really interesting exchange. I want to shift the conversation again. We've only got about six and a half minutes left, and what I wanted to come back to Helena. You know, in picking up on sort of policy priorities again, Helena. You know, one question we've been talking about transition a lot today, and the role of finance. But I wanted to ask if we're expecting too much of finance in the transition space, we can finance going concerns. We can't finance companies that are on a trajectory to going bankrupt. And so, my question to you, Helena, is, are we asking too much from companies? And, what could policymakers, and particularly the European Union, do more to accelerate transition?
Thank you, Nick. I think you hit the nail on the head, because there are, in my view, two types of economic activities, therefore companies that conduct those type of activities that need special support. Those are within the language of the taxonomy, those that conduct activities that we call always significant harmful, that is, those activities that have no place in 2050, right? So the companies that conduct those activities, like coal power generation, need to shift, to change their business models. And what we're seeing now is that they, with the existing assets, right? So your plant, your coal power plant, is like a ticking parcel that they keep passing it. And what we need is efforts, joint efforts and support for those companies to decommission those plants and those activities, to phase out the activities and decommission them. That's one of the reasons why the platform has been keen on developing technical criteria for decommissioning what we can call stranded assets. The other type of economic activities, and therefore the companies that conduct those activities that need special support, are those that we call transitional activities. So those that do have, they are essential for the economy, they have a place in a net zero economy by 2050, but for which there's no technological, either economically or technological viable solution to reach net zero. And those should be, the core of our efforts should be concentrated on that. Here is where, what I was trying to explain on having a sectorial strategy, on understanding, in which technologies, Europe might have a competitive advantage, in which technologies might be strategic, what it does need the support, and given support, investments, incentives and investment support to develop those technologies to allow the transition for those companies is absolutely essential. There's another point I think that is really important, which is on data. Until now, we have always, whenever we say data, we think about data coming from corporates or financial institutions. The Sustainable Finance Framework is going to provide, an incredible wide range of environmental, social, and governance data, all, very solid and consistent. But there's another type of data that we need, financial and environmental. And financial and environmental, that it is actually in the hands of member states, authority, different type of public authorities, supervisors, and so forth. For example, in order to really monitor capital flows and really target our policy measures, we might need, to centralize the information going on portfolios. For example, we also need, centralize, harmonize, and provide access to environmental data to financial institutions and companies on environmental data that is in the hands of member states or different public authorities on biodiversity, on adaptation, on pollution. So there's a lot of work that needs to be done on that. On that front, the platform has agreed, reached an agreement with the European Environmental Agency, which is one of our members, and we're doing a pilot project on how to centralize, standardize and provide information on adaptation, pollution, and biodiversity to financial institutions and companies, not only to implement the taxonomy, but also for their own transition. The third point has been touched upon, which is the supervision. I'm less concerned around sanctions, as I was saying, more on resources, expertise, and the different levels of supervision. Yeah, I am in different geographies and jurisdictions within Europe, but also the different emphases that is put on listed versus non-listed. And while from a financial perspective, that is totally reasonable, when it comes to contributing to reach the EU objectives, there's no reason why a listed company should be, more responsible than a non-listed, equally large company. And on your point around transition plans and transition finance, let me be very clear. I think that we have all the elements we need, with the exception of sectoral pathways and technology pathways that the Commission, I understand, is working on. The rest, we have all the elements just spread around. Now we need to make sense of all of them. We need to finish the taxonomy. We need to fine-tune the tools that we have. But my question back to the audience is that by 2024, by 2040, we need to have reached 90% of emissions reductions. How many CapEx plans do we need? How many shades of green do we need? How many more, right? Things need. No, we need to start doing the work, and we need to put everything into practice. A very important, really supporting the industry. And now is the time when we need to feedback constantly from the industry what's working, what's not, and be ready to adjust, the framework in order to support the transition.
Thank you. Now, you hit exactly the end time. However, in fairness to the two gentlemen here, I'm going to take an extra 5 minutes off the break, which is coming, or maybe 4 minutes. So let's say 2 minutes each to react to this question, the limits of transition finance.
There are limits? What? We've got to transition the whole planet. Of course there are no limits. We have to transition every single economy to become low carbon. We have to transition every single society to be resilient, to be prepared for this crazy heat and weather that is now setting in normally with mortality rates rising around the world. Of course, transition is everything. The NDCs, the National Climate Change Plans that will be lodged next year, need to become transition plans. They need to be transition opportunity plans. Because, there are three things happening. Not only have we got to get emissions down, not only have we got to deal with resilience, but also the world economy has started changing. When you look at electric vehicles, why are we putting up tariffs in this country on electric vehicles? Because we're scared the Chinese are going to kill our auto industry because they buggerized around for diesel for too long and refused to accept electric vehicles. And now it's a fifth the price to build an electric car in Shenzhen that is here. The world is changing. Think of the implications for oil. 45% of all cars in China this year sold are going to be electric. Think of the implications for energy, where 90% of all investment in 2022, let alone last year, in energy was clean energy, etc., etc. IRA, GX plan, InvestEU, all of these plans, the world economy is shifting. So you're either going to be a victim or you're going to be able to ride the wave. That's transition. And that's fast transition, I would say, and that's green bonds and so on. Now, our job in this industry, yours and mine, Nick, is to try and make it easy for people to understand what they've got to do to be able to survive the chop of change. Because we're going to see 10 years of incredible change. I'm heartened. I'm heartened because I think we've started getting temperatures. The forward forecast of temperature range has dropped the centigrade, a degree, because it's not enough. But we've actually been bringing the projections down. And now we've just got to finish the job. And that's going to create an incredible amount of investment opportunity if we do it right, if we work closely between government and the private sector, like we're doing in Japan.
My job description was suddenly vastly expanded. Ulf, le mot de la fin.
Well, I quite agree with Sean, right? And as I illustrated with that picture on the presentation, 9 years ago, we were building coal plants as a transition solution in Europe. Olaf Scholz, the current German chancellor, was there to cut the red ribbon. So a lot has changed. So that's the positive thing. What happens, though, when they have the positive change is that the other incumbent interests become more guarded and they try to do other things. And that's also where regulation comes in. I do think that there is a very big part of what ICMA is maybe not focused on, which is the private asset side, where we see lots of transactions going through, which we would like to raise with regulators, but are not always able to. So I think that's one space to watch, and also watch how that sort of influences government policy and so on. As an investor, engage. You have transition targets in your portfolio. Engage with your bond issuers. Ask them to actually put their transition targets within the bond structures. Whether you're paying a massive bond step up or not, or step down, or how you structure it, it's immaterial. Just start having that conversation is interesting. An issuer that does not want to financialize their transition targets probably is not believing in their own transition targets.
Thank you very much. All very cogent again. Please thank Helena, Sean, and Ulf. I think it was a really interesting panel.